Today's market call is brought to you by MoneyLion, the first digital ecosystem for consumer finance, empowering everyone to make their best financial decisions. I'm glad you decided to be with us here on the market call at 11 a.m. on this Monday, June 9th. Guy, Tommy, Dan, Nathan, you know who's waiting in the wings, Dan? Please tell me.
Carter Braxton Worth.
Yes, of Worth charting. Not Butters today. A little rainy outside. I'm looking out my right
Don't you have like
shoulder.
some Dreary Monday thing that you do on Dreary Mondays? Isn't there a song that you enjoy?
There's a song for you Allman Brothers fans out there. There's a song, Stormy Monday.
Stormy Monday? Yeah, you've done that before.
Great. That's a great song.
Speaking of...
Tell me why I don't like Mondays.
Why don't you like Mondays?
That's a song.
Okay. You know, the market guy eked out this little 6,000 level, nice round numbers. They always like those. And, you know, that was Friday afternoon. It was a response to a jobs data that wasn't as bad as expected. And I don't know what we're hoping for, because at this stage of the game, you know, we have a 4.5% 10-year yield. You have decent data that suggests that the economy is doing just fine, suggests that if you have inflationary pressures, we're going to read on that, CPI, PPI, Wednesday and Thursday, respectively. It's not basically the sort of thing that's causing the Fed to start thinking about lowering interest rates. Is that it?
No, I agree with that. And I watched the Squawk Box this morning, and they had two high school students that won some economics contest, both from the same high school, by the way. And they were talking to them, and Steve Leisman asked one of them a question about the Fed. Should they or should they not lower rates? And I thought he gave a very sort of thoughtful response. And his reply was, no, they shouldn't, you know, given all the things that we've talked about. And I'm like, man, this kid sort of gets it. So anyway, but clearly that's what the market is trying to come to grips with. I do think, you know, you mentioned that the economy is sort of hanging in there. I would say that's probably accurate, although showing signs of, you know, cracks in the armor around the edges for sure. But right now it's 6,006 or so in the S&P, about 130 something S&P handles from an all-time high. It's pretty remarkable.
Yeah, I mean, and I guess we're at a point, Guy, where it's like the path of rate cuts doesn't really matter for the S&P 500 right now, or at least the way that market participants, you could look at equity risk premium. There's a whole host of other things, right? But if inflationary fears are not a huge thing and the Fed doesn't feel the need to kind of lower, you know, normally you would see those things at opposite ends of this kind of tug of war between equity investors and valuations and the like. But we'll see. I mean, to your point, you've said this numerous occasions going back to the fall, if the Fed were to cut Fed funds, you know, that does not mean the 10-year is working in concert with it, that sort of thing. So again, you know, you and I won't know the answer. I'm really curious to see, though, how the stock market and how the treasury market reacts to whatever data we get out Wednesday and Thursday. All right, you mentioned him. Let's bring him in. Carter Braxton Worth of Worth Chart. There he is. There.
Man, how are you?
Handsome man.
Happy Monday. Happy Monday.
Yeah, I mean, stormy Monday. Maybe it's a dreary Monday. Who knows? CB Dubs, we know where you stand on yields. I know that, you know, we're basically at the same spot we were a year ago. You think
2 years ago, almost 3 years.
Guy and I overthink it. We think higher, and that's what makes a market here. But one of the things I found really interesting last night, you had a note out about the pace in which we've come back, you know what I mean, from those Feb 19 highs to the April 7th lows and back to where we are. And you break it down by some of the sector performance. And I thought that was really interesting. And so, you know, can you just start out by saying, okay, it's really easy to see an S&P at 6,000. We made a 6150 high in February. And you can say no harm, no foul, right? You know what I mean? Here we are. But the damage under the hood in some of these sectors is it's telling a little bit of a different story.
Sure. So the hope of the most recently published report was to put in context where we are now in relation to two obvious key reference points: the level from which the sell-off began, so that's the February 19th high, but also where we are now in relation to the April 7th low, right? So we know just optically we have a mark that S&P, as measured, was making an all-time high, 52-week high on the 19th of February, a Tuesday, and then we get a crash of sorts. Yes, it was a 21+% sell-off, at 21.35%. And then whether one calls it tariffs related or related to the deep seek or deep fake, whatever that was, and warnings. But either way, a sell-off and then an equally aggressive ricochet right back to or close to the level from which we sold off. But the path traversed is uniform. Most sectors were down during the swoon. Most sectors were up in the ricochet. But there's real dispersion if you look at what has gone on. And the two notable things, of course, is how well industrials, an important sector, were down less in the sell-off, up more in the rebound, and are now above where they were from February 19th high. So you see it here in a table, and it's busy, but if you were just to take the columns for what they are, for each sector is listed, its weight, of course, in the S&P, and the first column, the one that's red, is the plunge, right? So that's the 33 session sell-off from 19 February to the April 7th low. All sectors are down. And then, of course, the ricochet, which is from the April 7th, next column, April 7th low to present, all sectors are up. But the really, the tell, of course, third column is where each sector is in relation to where it was before the whole thing began, right? So we've got this 3.5 month wild round trip to nowhere. And the standout, of course, you see is that industrials, right, down less, so that's alpha, in the swoon, up more in the ricochet, that's alpha, and now above, one of only two sectors to be above to have recouped all their losses. The other one that stands out, of course, utilities, and I've written there, utilities did their job, right? Utilities went down less and are now, of course, up from where they were. Staples also did their job versus tech, and this is the interesting thing, tech didn't pay for the risk associated with it. Tech went down more during the swoon, up, of course, more in the ricochet. But if the end result is tech is only matched the market, higher beta, that's called on a risk-adjusted return series, poor performance, negative alpha. Anyway, we have charts and we can look at it, but whatever you think.
Yeah. So Carter, really quickly, this whole notion of the prior leadership coming out of, let's say, a bear market, is there normally new leadership? You're saying on a risk-adjusted return, tech has not been great, from those highs. How do you usually see that? Like, what's your work kind of suggest? You know what I mean? Because my view, and this is purely anecdotal, it's not the sort of work that you do, is like, we're in a market right now where some of the names might change in and out of the faithful eight, but not likely anytime soon. We just had Broadcom join the $1 trillion club in the last 6 months or so. But it's the only way the market could really press forward and on its way to 7,000 over the next 6 months, a year, whatever the hell it is really by the mega cap tech stocks. Is that fair? I just don't see what other sectors could drive that performance.
Two ways to consider that. I think one is the simple weightings, right? That's the nature. Let's go back maybe to the top table to look at the weight. It's all so dependent on, right, a handful of stocks. So we know that tech at 32%, but you see that telecommunications, of course, is now getting to be, communications used to be just AT&T and Verizon. Well, now it's got things like, Meta and Google and so forth. And so it's still, even financials, JP Morgan and Berkshire are a huge weight in the sector. So it's so dependent on, to your point, just a handful of names. I mean, with materials, think about DuPont and Alcoa, great old line businesses. U.S. Steel, the whole materials sector, 1.94%, when Apple itself is 6.7%, and real estate, right, and utilities, and these are huge parts of the economy and huge employers, of course, but they're absolutely meaningless, literally, in the market's weighting, and therefore can do little to help the market. So to your point, yes, it's so few names that drive everything.
Let's go through your charts because, as you said, information technology and financials, I think about 47% of the overall of the components of the S&P. So you started with information technology. So my question to you is, when you see a move like this, I mean, obviously we talked about the sell-off, but the steepness of the response, I mean, it's as fast as we went down, we went up. I mean, does historically this sort of last? I mean, is there any way to sort of gauge if this is going to be a continuation of this theme?
Yeah, I mean, this is the ultimate beta trade, down more and up more, right? Now, the thing that stand out to my eye is that, of course, notice tech the S&P peaked where that first vertical line is, right? Roman numeral 1. But tech had already peaked 3 months prior.
Mm-hmm.
Right? So tech was struggling before the market itself peaked. I would characterize this circumstance here simply as back to a difficult level. There's a bit of overhead supply to contend with and move through before being able to presumptively break out. But a ricochet like this, at a minimum, sell calls. If you were in XLK, right, the actual ETF or other measures for the tech sector, I would trim or sell calls.
Yeah, when you look at this, I mean, Carter, like help us think about also, Guy just talked about the steepness of the return here. What sort of like, like you talk about style, right? All the time, as far as looking at, technicals and the like. What would it take stylistically to kind of make a new high and then establish a new range above that after such a sharp move higher? And obviously you're talking about this V here, but in my mind, when I think of just the things that you don't care about, the fundamentals and valuation and all this sort, I'm hard pressed to think that we have a reacceleration in the economy that would justify some of the multiples of the biggest names that we have driving performance. And so how might you, if we take a run at 6550 in the S&P, you know what I'm saying? Like, what would it take, in your opinion, to feel confident that, we've established a new range above the prior highs?
Well, time and price. I mean, it sounds an absurd answer, obtuse, elemental, but that's what it is. It's and maybe we should go to the S&P chart instead of the tech sector chart. We'll go to the market itself. But the point is that it's now it's very symmetrical, right? We're back almost the level from which the sell-off began, and in principle, getting back to that former high, you would sort of back and fill there if it's healthy, back away a little bit, and then ultimately a breakout, and that would start to establish, at a minimum, it would set these lows as good lows, right? That we're not any sort of test or retest of the April lows, but it's a process. It's time and price. That's the only answer, at least that I know.
Yeah, let's look at a couple of these things, because as you mentioned, you could see it in the chart, in the graph, but then when you see each one displayed the way we've displayed the S&P and information technology, it starts to all make a little bit of sense here. So if you want to run through, obviously the couple stick out to me. You mentioned the outperformance of industrials and the underperformance of healthcare, but break it down for us.
Sure. So financials, it's the same shape, right? It's the same path traveled. It's just rates of change, beta and so forth, but basically same general high, same general low, same general recovery. And yet financials, of course, are sideways now. 1, 2, 8, 12 sessions, 15 sessions. So they're underperforming actually week over week because the market has continued higher, a little bit of relative stall. We'll just go through each sector and we can look. So this is obviously a problem, right? What are the things that jump out? We know that it peaked in December, not in February. We know that its recovery, while the same percent or close to the same percent, is feeble, and we know it's well below. Now, Tesla's a big weight in this, right? But Home Depot's not acting well, and other names. So this is a burden. What would it take to get new highs here? A lot of heavy lifting. Yes. This is Netflix, right? This is a big driver, but here too, not back to the high, still below and so forth, but it's the same shape. That's the point. Whereas others won't be. Let's keep going. Not the same shape at all, right? And this is what a crisis this has been. And this, interestingly, was happening. Lilly's been in trouble for what, 6-7 months, United Healthcare, but this has been going on for 2 years.
Longer than that,
right?
Yep.
That's right. That's right. So things like Pfizer, things like Merck, other great names, Johnson & Johnson, big weights have struggled. At some point, I would have to think as a contrarian play, this has to have some catch up. But, there are things that in the fundamental area that are people could be worried about. Government intervention, right? That kind of thing. You can regulate healthcare out of business, as we know. Anyway, moving on. This is the winner, right? This is the one that's recouped all of its losses. And so again, the key is it went down less in the sell-off, recovered more in the recovery, and is making new highs. Now, what that says, which is so curious, what does that say when, 3/4 of GDP or consumer, not industrial, maybe, maybe the U.S. industrials, the big names, are aerospace, a big driver of this. If you see GE, for instance, Boeing's come to life, but John Deere and Caterpillar have acted well, and other idiosyncratic names. My own hunch here is to trim. This has come a long way. Sell calls.
Carter, it seems like you're inclined to kind of trim strength here. We just talked about some of the stuff in the sector. You were talking about the S&P 500 and what it might take to kind of establish a new range. But then on the flip side of that, energy and healthcare look a little similar, right? When you talk
very
about
burdened, right? And the question is, and this is always the conundrum: weakness. It's usually wrong to stay. It's usually right to stay away from weakness and to embrace strength. That's the general nature of markets, and yet at some point, something like a healthcare, I mean, we can all the way down to energy. At some point, there is mean reversion, and it's right to be contrarian. That would be my hunch here. Here's energy. I mean, what a disaster! What a disaster! Imagine it's down over the past 3 years and underperforming and so forth, and yet big yield out of the two big names, Exxon and Chevron, and great franchises, and Halliburton and Schlumberger and Devon and Conoco and EOG. And so such a small weight in the S&P, it's almost a little bit like a lotto ticket. My hunch is to have some.
We got a couple. I'm sorry, I was saying real quick. We have a couple questions directed at you before we 5,000. One is from Rajan Chopra. He's asking about UNH, which, by the way, has not bounced whatsoever. I mean, you just addressed it in the healthcare chart, but let's just maybe look at it, because he's asking, does the chart say anything? I mean, my 2 cents is there's been no bounce whatsoever, which leads me to believe there's another downdraft. Do you have any views here, CBW?
It's pretty, I mean, dangerous stuff. Right now, the question is, how much has been priced in after dropping and gapping like that once, and then a second time, and then a third time? Presumptively, more than 10% of the problem. Presumptively more than 50% of the problem. So the question is 90% of the problem priced in, or is it all priced in, and therefore it's right to be contrarian? I guess small speculative long is my thought, but the key word is small.
We have a question about Boeing. I'm sorry, Dan, real quick. If you want to throw up a 5 or 6 year Boeing chart, Stephen, from the all-time high that we saw, I think in 2019. I mean, you can draw a downtrend line, and you got to go a little bit longer than that. And you can see that, we're about to, I think, get to sort of this third point of that downtrend. And we've been talking about this for a while. So if you want to draw that, you'll see the question is around, is there any more room to the upside in Boeing? And my suggestion is, yeah, there is, Carter Worth. I think we can make the third point of what's been a pretty long-term downtrend line if Stephen wants to draw it.
Yeah. So again, it's about your time frames. The question is as burdened as this is, planes literally falling out of the sky, and their debt is quadrupled, and all the things that, at the same time, there's never going to be. I mean, well, that's not me saying never, but truthfully, we can use that word. There's never going to be a new major. But there's going to be the Carter, Dan, and Guy airplane manufacturing company. There isn't, right? So it's a big operation to pull this off, and Boeing will be around. So if one has that long-term view, the point is, and Guy, you're making the point, you play for the breakout above this downtrend line. Now, as a trader, tactically, it's quite extended.
Yeah,
I would call calls. So
it's funny. I thought we're actually still away from that downtrend. As it turns out, with time decay and stuff, we're right up against it. So I guess to answer the question about Boeing, to your point, maybe you move your feet here a little bit. You say, you know what, Guy, you know what, Carter, Dan, I don't want to move my feet. I think we're going to break through this downtrend and maybe get back to the levels we saw a year and a half or so ago. So this is a pretty cool looking chart, Dan.
Yeah, no doubt. This is one of those ones, I think, where, Carter, sometimes you do your work, you look at some of the other stuff in the sector, you look at the broad market, that sort of thing, and you might say a pair of twos right here, because, depending upon what your inclination is on some of the, like the stuff that we just mentioned, macro, sector, blah, 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 trade, you might say that, this thing is on its way back towards $300 if we get these 4 things to happen in this direction. Otherwise, maybe it gets rejected. You could also draw an uptrend from that COVID low, attach it to the 20, you know what I mean? And you got a nice little pennant formation there, right? I mean, so.
Yeah, look, it's a big move to a difficult level. So again, it's time frames. If one has a long-term view, it's pretty clear that Boeing will survive. Let's put that. So bankrupt, we can check that off. No. Will they ultimately, over time, keep making airplanes in 2026? Yes. How about 2036? You betcha, and so forth and so on. So is this company ultimately worth more in the future than it's worth now? That's the conclusion. You buy the stock. For traders, let's go to the 1-year chart. This is a very steep and uncorrected thing. So if I had caught some of this fairly well, you trim a little bit. And that, I think, was the question, CR Taylor, right? Does it have room to run? It has room to run depending on your time frame. If you own this right here, I would sell calls.
All right. Last question. This is from Dan N. Semiconductor stocks, blah, 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 blah. All right, what do you think of the SOXX here? I just made that up. That's me. We put this up here. This is the SOXX. We prefer this to the SMH. We just think it's a better constructed ETF. That's a 1-year chart. Maybe flash over, Stephen, to the 5-year here. And this kind of speaks a little bit to what you were talking about with some of these other sectors that have actually not performed that well off of the lows relative to their highs. And this one topped out, over a year and a half ago-ish or something like that. What are you seeing going back to the 1 year as far as the SOXX is concerned?
Yeah, huge move, right? Along with everything else, and day-to-day stretch. Remember, moving above a downtrend like that is not just an all clear sign. It's a positive development, but it doesn't ameliorate the fact that it's still very steep off of its low. And so here too, we're talking about 148 to 223. So if you bought a stock at $14.80, it was trading at $22, $23. It's a big move. You might want to book some of that. I would sell calls.
I agree with that. I mean, it makes sense. Is this going to be one of those false breakouts, Dan? I mean, obviously, NVIDIA's got a lot to do with this recent resurgence in Qualcomm. AMD's off the mat a little bit. So people are once again getting excited about the semi trade, but we'll see. I mean, we've seen false breakouts before, and if we do sort of a back and fill back to the 200-day moving average, then we'll see what happens if, in fact, we can maybe finally fill that little bit of a gap that was created a while ago.
No doubt. All right, Carter Braxton Worth, we appreciate you running through your note. We appreciate your commentary. Thanks so much, my man.
All right. Bye, guys.
Carter's the man. We have a question about money supply, and I don't want to get too wonky here, but it's the M2 money supply, which has been basically lower left, upper right. It sort of topped out in, I don't know, July of 2022. We seemingly were coming back down only to have it reaccelerate. So there are a lot of people out there that say as money supply goes, so goes the stock market. And as I'm sitting here right now, I think at least according to the M2, Dan, money supply is at an all-time high. So that addresses that question. Yes, it does look like a meme stock. We talked about Boeing. I think that's interesting. Gary Webb's asking about silver. I know Carter had a note out about silver. If you want to throw up a silver chart real quick, but I do think there's more room in silver. The problem, of course, is every time silver seemingly becomes a story, you get these pretty precipitous drops, and you've seen it a couple times over the last year or so. But the good news is we're through that sort of prior high that we saw earlier this year. So I think silver's still in play here, Dan. I know you don't have huge views on it, but I like silver here to continue sort of this stealth move that we've seen.
Yeah, it's interesting because I can't remember. We had a strategist or a technician on Fast Money recently, and if you want to pull this out to a 5-year, and if I didn't know what the underlying was here, I'd look at that and I'd say, well, that's a nice little breakout. And then you look at this kind of uptrend that's been in place. But basically, other than the April lows, you've seen a series of kind of higher lows, a series of higher highs, if you will. And now we're just making a new one. So, it looks constructive. Listen, me. I mean, I get why people own gold and for what reasons to put it in your portfolio. I don't get as much as it relates to silver, but I get why people, they are into these metals. Guy, you just mentioned Qualcomm before, and so we drew a chart of a 1-year downtrend. We see where the moving average is here. We're right up against it, to use an expression you like to use here, but we're through it. We're through the downtrend. We're kind of contending with what has been, a flattening to slightly lower long-term moving average here. This seems like the sort of thing, man. It wouldn't take a whole heck of a lot to get this back towards those highs from, February or something like that. Valuation makes sense. There's always activists swirling around. I'm just curious thoughts here, because this is not a generative AI play. Let's just be really clear. They sell chips into, Copilot PCs and the like here, but we haven't seen those take off recently either.
Recently we were talking about the underperformance of Microsoft from last summer, and then obviously that's been sort of washed away. As we're sitting here, Microsoft is right back to those levels. So you can say the same thing about Qualcomm. I understand they're completely separate companies, but you just turn in terms of, if you want to do longer term, you see what I'm talking about. Just this underperformance this last summer. So the question is, could we potentially see the same type of move in Qualcomm that we saw recently in Microsoft. And breaking this downtrend line suggests maybe. And to your point, listen, you got to walk before you can crawl before you can walk. So maybe we have to get back to that second point of the downtrend line. But this could be one of those stealth semi names that we wake up a month and a half from now and say, holy shit, look at this move in Qualcomm. So yeah, I'd keep a pretty close eye on this to the upside for sure.
Yeah, it trades at 13 times. The problem is it's low single digits expected earnings and sales growth. And so you say to yourself, what's the thing that causes that to reaccelerate? If you could kind of put together some sort of fundamental mosaic where that could happen, you say to yourself, okay, it's a 55% gross margin company. If they can expand margins a little bit, that sort of thing. Good balance sheet, $170 billion market cap. They have nearly 14 in cash, 14 in debt. They're making an acquisition right now, $2.1 billion of something that I haven't taken a close look at, but again, that's a bit of a tuck in. So who knows there? It's just, I think it's interesting that you brought that up. I know it was the technical setup that in the acquisition that got you going, and the valuation, but it could be a value trap, right, Guy? I mean, when you think about it in that regard.
It has, listen, we've seen that a number of times where they report earnings, disappoint, stock creators. I mean, without question, you could find yourself. And it has been a market underperformer. I guess for people out there, the enthusiasts out there, they say, they'll say to themselves, is this a chance? Like, am I being given the opportunity in Qualcomm to get the same type of stock performance on that breakthrough, a downtrend that we saw in Microsoft? Again, understanding it's entirely two different companies.
Yeah, no doubt. Well, that being said, Microsoft, which obviously, if they're making these Copilot PCs, they have a hardware group, that's meant to kind of use some of these Copilots and agents that they're building into their software. They're going to take specialty sort of chips to do this. I mean, this is in one way like an extension of that trade, but again, it's going to take a little time. So this is one that's definitely interesting, but maybe not right here for me. Let's look at the call today. Morgan Stanley downgraded McDonald's to equal weight from overweight. McDonald's is a top quality business, but hasn't been and probably will not be insulated from the structural pressures on fast food. I don't know what those structural pressures are. Maybe it's something to do with the Ozempic and a whole host of other things. They've gotten a lot of their labor out of there. I don't know if you notice when you will go in there, you're ordering from a big iPad and the like here, but maybe the cost pressures. Is it like a consumer that's trading down? Talk to me about McDonald's.
First of all, if I were to walk, if I do go to McDonald's, it's through the drive-through, number one. Number two, if I were to walk into McDonald's, let's just say I'm on the New Jersey Turnpike or something, and I need to pull over to take a leak. I am not ordering from, what do you call it?
A big iPad.
I will wait for a person to come behind the counter so I can interact with an actual human being. So, but I think we all understand that. That's me. But I'm glad you brought it up. In terms of the stock, it is concerning that since, I don't know, March-ish, we've made a run to this sort of 325 level a few different times, only to be thwarted. I think this is like the fourth time or so that we traded up to 325 in a pullback. That's a little concerning. So if Carter were still with us, he would talk about potentially a bit of a rounding top. We're right at this uptrend line as you've drawn. We're right at the moving average as you've drawn. The question is, what happens here? I am still a believer, but when you see a downgrade in a name like this, which typically you don't see all that often, you definitely have to take notice. So you got to watch over the next couple of days. We break this downtrend and maybe we trade down the levels we saw earlier this year, which is about 280 or so.
Yeah. I mean, one takeaway, Carter actually had brought this up to him one day on the set of Fast Money. And I was like, well, do you like this consolidation back towards those prior highs? Yeah, we had a gap down there. I think that I can't remember what that gap was. Maybe it was earnings, but then it didn't take long to kind of get back there. He's like, no, I mean, on a relative basis, it actually acts kind of poorly. And then when you see the sort of price action right here, we're just spent a lot of time talking about, sectors that have come back towards those highs and what sort of outperformance you've had. So it seems like the consumer is still of focus here. You know what I mean? When you think about it from an investor standpoint, all the uncertainty that we heard from a lot of retailers. So, Costco is one we brought up last week, not acting particularly well after disappointing comp store sales. So we'll keep an eye on those. I do think it's interesting, though, that the semis today are the ones driving, whatever outperformance we're getting. One last thing before we get out of here. Late last week, and Carter just mentioned financials, so I just thought it was interesting to bring up. Look at this KRE. So this is a regional banking index. It really acts very poorly. And we kind of highlighted the fact that it looks a lot like the small caps, the Russell 2000. And so I guess if you're just trying to find things that would kind of like lead you to believe that, we see people piling back into the things that have had those sorts of big returns, but it's the financials and it's some of these other sectors. You could say, well, for every sector like financials, we have the industrials, that sort of thing. But this is the one I find really interesting. When you talk about that money supply, you talk about the potential for Fed to lower rates, you talk about, tax and trade and all this sort of stuff. I would expect these stocks to be trading better.
Trade better than they are. They have not. Look, I mean, if you were to look at this through the lens of what we looked at with Carter in terms of the V reversal, I mean, this has been a marked underperformer since those highs we saw earlier this year and the lows into April. I mean, yes, we've seen a bounce, but not nearly to the extent that some of those other sectors. I mean, it mirrors maybe what we've seen in healthcare and some of the other things. So I think you're right to point it out. And listen, I think it's telling a story. I think the small caps are trying to tell a story. And I think by extension, the small and regional banks are as well. And definitely before we get out of here, I only bringing this up because I have no idea what this means. Marduk, son of EA. Slayer of Tiamat. I mean, somebody needs to help me. I'm sure Jacob knows.
I saw that one too.
Gamer or something. I mean,
I was definitely going to hit that because I knew that would kind of tweak you a little bit there. Yeah. It's amazing. Whatever's going on there, Marduk, I'm here for it. Okay. Thank you.
I don't know what it means. Why is Tesla bouncing? Well, throw up a Tesla chart. And I know what we said. I mean, I just want to be crystal clear. When it got down to 220, we said across the board, you can't be pushing on the downside here. We've traded down to prior support. It's going to bounce. We got up to 360, which, as we said, was going to be a 50% retracement of the all-time high in that aforementioned 220 low. We are selling off for a myriad of different reasons, not least of which this little spat that the administration is having with Elon Musk. Why is it bouncing? To answer your question, I think it's just people squaring up ahead of the event this week.
Yeah, and so that would be on Thursday, the robotaxi event. And I mean this sincerely. I feel bad for Tesla shareholders who have long-term time horizons and have had to deal with this sort of volatility because it's one of the few ways that people can express views around Elon Musk, right? It's the only public company that he has, because it really takes away from whatever fundamental, analysis you want to do on the EV business and how you want to model out robotaxis and robots, and where we stand on that. And by the way, Guy, I thought we'd get to 300 from that 220 level. I certainly did not think we're going to break out and do what he did. And I certainly didn't think from the 220 level back in November, we were going to basically double from there, which was kind of just shows you how much this stock is being driven by non-fundamental sort of reasons. So, there was a couple downgrades today, Argus and RW Baird. And really the crux of both of those is that the uncertainty around tax credits, the relationship with Trump, it was obviously a benefit for a while. Now it's gone the opposite way. And I just think that if robotaxi event disappoints, I think you probably see this stock headed back towards 250. I just, and especially it's like the genie's out of the bottle with the stuff with Trump and what Trump said and what Musk said. And you got to think that these credits are going away. And a year ago, when Musk thought that this reversal in pricing, this reversal in competition, this reversal in demand was going to happen, he didn't care about credits. You know what I mean? He didn't care about export restrictions in the Chinese. He has actually routinely said that the Chinese pay, that's the biggest risk for them, lower cost sort of EVs all over the place. But the EV business is bad. It's not getting better anytime soon. And robotaxi is the only way it can save it, but they haven't articulated pretty well how that happens because they don't want to own a fleet of Teslas, right? Just to put into a robotaxi sort of arrangement. So that'll be really interesting to see on Tuesday. And then really quickly, Guy, Apple today, you mentioned this numerous occasions over the last week. And I think it's really interesting. WWDC last year, there was a lot of anticipation about Apple Intelligence, right? The stock closed flat that day. I think the event closed an hour, before the market closed, that sort of thing. Stock closed flat. there was like market participants were like, meh, like nothing there. The next day, some upgrades, some geeked up investors, and the stock closed up, I think in 2 days, 10% or something like that. What are you expecting here?
Different setup now. I think the expectations were high last time. Maybe they exceeded expectations. Maybe people were looking for an excuse. You obviously had some broader market tailwinds to help you. I think now that we've retraced the entire move, I think expectations are equally, well, as high as they were then. I think they're as low now. So maybe the bar is lower. The problem, of course, is it's hard pressed to even think they're going to sort of get over that low bar. So I don't think listen, I think it's no man's land here, but if you're forcing me to sort of choose, I think we go lower from here.
Yeah, I'm pretty fascinated with these two names. They're the worst two performing stocks in the Fateful Eight year to date, and Apple's still down 18% of the year, and then Tesla's down 27%. I think here's a situation where they are reflective of the price action is reflective, in my opinion, of the fundamentals. So we'll see how that shakes out.
There's one more question from G Swizzle. I just see that coming in.
G Swizz.
I don't know if it's a he or she, but they ask, is R.W. Baird a Baird company?
I mean, yes, that would be yes.
Well, you brought it up. I mean, you said R.W. Baird, and every time we hear we hear about them being, so I would imagine R.W. Baird would in fact be a Baird company, along with the other companies that are Baird companies.
The reason we find that funny is that there's R.W. Baird, and then there's a company called Strategas that R.W. Baird bought. And every time Strategas people are on fast money, we have to introduce them, not you or me, but as a Baird company, which I think is pretty funny. And you obviously do too. All right. So Gene Munster's joining me today after the conclusion of WWDC. He's of Deepwater Asset Management. I've been listening to Gene's breakdowns of WWDC for like 15 years. So he's going to give us the 411 on what he sees there. And we'll probably talk a little bit of a Tesla expectations in the robo-taxi. So that drops tomorrow in the Risk Reversal Media Pod. We'll be back tomorrow. Actually, very special programming. 2 p.m. tomorrow, 2 p.m. And here's why. I am moderating a panel at iConnections, New York City Global Alts at 10 a.m. It's on private investing in the tech industry. I'm interviewing a guy named Josh Wolf, who I think is genius. He's been on our podcast a bunch of times. He was a seed investor in Anduril. This is now worth $30 billion. Amazing company. And if you're into defense, great. If you're not into defense, you're not going to like Anduril because of the things that they do. Guy is moderating a panel at noon tomorrow. What is yours?
Geopolitical, all the things surrounding it. It's me and four others for a half an hour, which will go by quickly, but it'll be fun.
Yeah, looking forward to that. We'll give you like the little 411 and all those. We'll see you tomorrow at 2 p.m. 2 p.m. Utah. Give me 2.